how I think of it, I think there's a 60% chance that it's just a normal crypto cycle. So Bitcoin finishes 150 to 250,000, i.e. it does a few X the last all-time highs. There's a 20% chance that because of the ETF and how the economic cycle works, everyone gets overexcited about rate cuts, whatever, that we kind of front load it and it's short. But then there's another 20% chance that this actually extends further than we expect because institutions and others come into the space and it broadens out. So I think 60% chance normal cycle, 20% super cycle, 20% actually a short cycle.
Don't forget to subscribe, crypto traders. Let's continue with the interview and the analysis of this one.
Bitcoin often undergoes cycles characterized by periods of intense price appreciation followed by corrections. 3 possible scenarios for Bitcoin's cycle completion are under discussion among analysts and investors alike. Firstly, some experts anticipate a bullish continuation where Bitcoin's price rally persists, driven by increasing institutional adoption, macroeconomic factors, and growing mainstream acceptance of cryptocurrencies. Secondly, there's speculation about a prolonged consolidation phase, where Bitcoin's price stabilizes within a certain range, allowing for accumulation by long-term investors before another upward trend emerges. Lastly, there's a scenario of a bearish downturn, where Bitcoin experiences a significant correction, potentially triggered by regulatory concerns, market manipulation, or external economic shocks. Such downturns are not uncommon in the volatile world of cryptocurrency. Coinbase recently conducted a survey to gauge crypto owner preferences in California, a state known for its tech-savvy population and early adoption of innovative technologies. The survey results offer valuable insights into the demographics and investment behaviors of crypto owners in California. They reveal a diverse range of preferences among investors, with some favoring Bitcoin as a store of value akin to digital gold, while others are drawn to alternative cryptocurrencies for their technological innovation and potential for high returns. Additionally, the survey highlights the increasing interest in decentralized finance applications among crypto enthusiasts, reflecting a growing trend towards decentralized platforms and peer-to-peer financial services.
I'm kind of thinking Bitcoin finishes this cycle closer to 250,000. I think a lot of people are lower. I think it might be higher because of the dynamics of the ETF and other stuff. I'm pegging Ethereum between 15 and 20,000, and I'm pegging Solana between 750 and 1,000. So my view is Bitcoin starts the cycle and outperforms in the start. Then people go out the risk curve, ETH. We're going to have an ETH ETF. We'll see the market pick up there.
Right.
But the horse that's moving faster is the one that's coming from a smaller adoption base. Our actual problem is actually demographics. There's too many old people. Okay. And the old people all own equities. And they also have all the wealth. So if you were to allow the market to go down 70% that people want, we want that bear market to show the bankers that they've done it wrong. We wipe out 70%.
Recently, Bitcoin witnessed a significant surge in its value, surpassing the $47,000 mark. This surge was primarily fueled by the approval of exchange-traded funds, marking a milestone in the integration of digital assets into mainstream financial markets. The approval of Bitcoin ETFs represents a significant step towards legitimizing cryptocurrencies as viable investment instruments. ETFs provide investors with a regulated and accessible avenue to gain exposure to Bitcoin's price movements without directly owning the underlying asset. This regulatory approval not only boosts investor confidence, but also paves the way for increased institutional participation in the cryptocurrency space. Institutional adoption has emerged as a key driver behind the growth of Bitcoin's market capitalization. Large financial institutions, hedge funds, and corporate entities are increasingly recognizing the potential of Bitcoin as a store of value and a hedge against traditional market risks. Their entry into the market not only injects liquidity but also instills a sense of credibility and stability, further validating Bitcoin's position as a legitimate asset class. The growing institutional interest in Bitcoin is fueled by several factors, including its finite supply, decentralized nature, and increasing recognition as a hedge against inflation and currency devaluation. Institutions are diversifying their portfolios by allocating a portion of their assets to Bitcoin, viewing it as a strategic long-term investment that can potentially yield substantial returns. Moreover, institutional involvement brings with it a level of sophistication and professionalism to the cryptocurrency market, paving the way for the development of robust infrastructure, regulatory frameworks, and risk management practices. As a result, Bitcoin's adoption curve continues to steepen, drawing interest from a broader spectrum of investors and stakeholders.
The wealth of America. You simply can't do it. And that's the collateral for all of the debt as well. So you blow up everything. That's what we learned in 2008, which was like, they're not going to go there. That was what Draghi did in 2012. It's like, whatever it takes, but we are not going to do that, which is the 1929 outcome. So what they're actually trying to do is rescue the baby boomers and rescue the governments who are trying to keep economic growth going with an indebted old population. So they're not trying to transfer money to the super wealthy. That was the unintended consequences. I don't think they understood what they were doing was debasing currency. And when they learned it, they're like, oh, this is magic. Let's just keep pressing the magic button. Assets go up and we're saved from ever a debt deflation. What is this smart contract business? So I want people to understand that everything humans do is basically a contract. All societies are organized by contracts. Me appearing with you was a contract over email. Even how societies work, how religions work, everything they're contracts. Some are not that important. Like meeting a friend for a drink, you can say, hey, listen, I can't make it. Nobody's going to sue you for it. It might cost you more drinks next time, but that kind of thing. But others are really important. Insurance contracts, derivative contracts, contracts for ownership of property. All of this can now be digital, so you don't have to trust a third party. So we're away from the system of money. We're now talking about verified truth, electronically verifiable truth done by code. So that means we can then get rid of middlemen all over the place. And we've all spent too much money on lawyers. We've all spent too much money on accountants. We've all spent money with notaries. All of this stuff disappears. Things like insurance companies don't need to be insurance companies anymore. They're just contracts of payments and contracts for pooling of capital. So it can be in literally anything, from a ticket to a sports event to the most complex derivative contracts in the world, can actually go on this new rails. So it's much bigger than either of us first thought when we first saw it. It's like, oh wow, question on everything. Global debt is 400% of global GDP. These are bananas numbers. So what does that mean? We talk about debt a lot. What it means really is the collateral, the assets, the back of the system have lots and lots of people claiming on them. So if anything goes wrong, you get a fraction of your money back. Also, we're learning that banks are now bailing in creditors. So you find that the issue in the leverage world is you actually don't think, whatever you think you own, you don't actually own. It can be taken away from you.
Financial systems operate within a web of interconnected relationships and transactions. This complexity means that when issues arise, the system often has many claimants seeking resolution. This multiplicity of claimants can dilute the available resources for resolution, resulting in only a fraction of the invested money being returned to stakeholders in cases of financial distress or collapse. Bail-ins and ownership rights. Banks have adopted a strategy known as bailing in creditors to mitigate financial risks. This approach involves using the funds of creditors to stabilize the bank during times of distress. While bailing in creditors can help prevent systemic collapse and taxpayer bailouts, it also raises concerns about ownership rights, particularly in the leverage world. Creditors who once felt secure in their positions may find their ownership rights challenged or compromised as banks prioritize stability and solvency through these measures. In navigating these complexities, it's essential for stakeholders to grasp the evolving landscape of financial systems. Understanding the implications of system dynamics and financial strategies, such as bail-ins, can empower individuals and institutions to make informed decisions and adapt to the changing financial environment. Awareness of ownership rights, risk management strategies, and the broader implications of financial mechanisms is key to thriving in today's intricate financial ecosystem.